So thank you very much. So we are very pleased to have Professor Wuyang Zhao is here from the University of Texas at Austin, and he is going to talk about short squeezes after short selling attacks. So that's the title of the paper. And Wuyang, just like I was saying before we started, we will give you 5 minutes, so uninterrupted, so you can discuss your paper for 5 minutes, and then the president we open it up for questions. And for the audience, people in the audience, if you can raise your hand on your on the screen, or using that hand signal, or on the chat box, you can post a message saying you have a question, and then I'll announce that you have a question and you can ask your question. So with that, so let's begin. Thank you very much again, Wuyang.
Thank you, Srini. Thank you everyone for attending here my talk. So it's great to be here. And as I said to Srini, I have never been to India, but I'm always fascinated by everything related to India, from the movies, foods, and culture, everything. And Partha actually shared a lot of his insights with me, like share a lot of recommendations of Indian movies. So it's I'm looking forward to visiting in person sometime in the future. Okay, so another thing is I noticed this is recorded, so as a result, I will be able to pick up your comments later on. So I might not kind of distract myself writing down the comments. So just say that in advance, and I'm paying 100% attention to your thoughts. So this is a paper co-authored with my friends, two friends in University of Southern California, Lorraine and Forrester. So the title of the paper is "How Can Bad News Increase Price?" So we want to document short squeeze after short selling attacks. Let me start with a specific case in our sample. So a short seller, a short selling firm, Hindenburg Research. If some of you guys find this name a little bit familiar, that is probably because this is a short selling firm that exposed the fraud of Nikola last year. So it's now getting a lot of attention. So this short selling firm published a short selling report on one firm called Reut blockchain on December 11th, 2017. So let me give you some like basic summary of what is this short seller talking about in that report. So basically, the short seller is accusing the firm, extreme high overvaluation for it has now good foundations. Most importantly, right? This firm actually made the transition to blockchain a few months ago. Previously, it's doing something very differently, right? And also in the report, the short seller listed a set of serious allegations related to this related party transaction and inside dealing, like tunneling of the public firm. And most importantly, right, like for example, for the second part, the company is paid $12 million for like 2 weeks old entity. This just immediately sounds surprising and suspicious, right? Now, if I ask you, if you read a report like this, how would you expect the price will go? You might, I think, we might expect the price will drop, right? We don't know how much, but I think the expectation would be the price will go down. Very surprisingly, actually, it's not. The price actually increased 50% on the day, and then another 30% on the second day. And if you wait for another 3 days, it will increase another 60%, and then it will drop. So if we look at 1 quarter from the attack date to the 1 quarter later, the price will drop like 50%. And if you look at 1 year, price drop 90%. In other words, I think it's fair to say that the short seller actually was correct, but the short seller was very miserable that in the first few days, the price increased so much. And just put that into the context, actually, if you look at 2 years later, the price is still very, very low. So this is further evidence that the short seller actually was correct. Now, so this is what we're talking about. We want to explain why this is happening, and we want to propose an explanation that, we say the short squeezes are the driving forces of the initial price rise and then later reversals. So we have a few motivations why we're doing this. Suppose I was invited like 1 year ago, then I had to explain why we want to do short squeeze. However, I think the GameStop changed everything. The GameStop is really changing the game these days. Everyone now is talking about the short squeeze. And I guess it's fair to say that we all know the GameStop happened earlier this year. It's a fascinating story that the price increased almost more than 20 times and then crashed, and then later on it's almost getting back to like $200. So short squeeze is now on everyone's mind, from the regulators to market participants to academics as well. And there is another motivation. Actually, that's before the GameStop drama. So in recent years, there is a lot of debate on how to regulate short selling, and particularly how to regulate short sellers who publicly share their short thesis with the market. So we call activist short selling. So one famous short seller, Mark Cohodes, published a very controversial article on Financial Times last year. Basically, the idea he proposed is that, to get rid of all these manipulative short sellers, we have to make the following regulation. We need to require short sellers hold their positions for 10 days. And this is not only about the short side, this should also apply to the long side as well. Like, as long as you share your opinion with the public market, you should put your money where your mouth is and stick to that and hold the position for 10 days. And then in this way, we can make sure that you don't have this pump and dump and short and distort schemes in your mind.
So can I ask a question?
Oh yeah, please. Yes.
Yeah.
Please.
Just for clarification, and you probably have a slide coming up on this. You have different parties here, right? So you have the guys who put out the what you call them, the
short selling reports.
Yeah, the short selling reports, right? What do you call them actually? They don't have a name, right?
You mean the short selling specific?
Yeah, they may. The thing that I'm trying to ask is the guys who put out the report. And somewhere in the paper you talk that they also hold short positions. So they don't necessarily have to have a short position, right? Or is it?
Yeah, correct. So a little bit institutional background here. So most of the time they do, but it's possible that they also team up what they call balance sheet partners, meaning that I'm publishing the report, but at the same time, I'm coordinating with another big funds, like big hedge fund or family office, who can put a lot of money there. Because at the end of the day, it's like the research is very expensive. So you want to get most out of it, right? So in that case, usually the short seller will split the profit with the family office or the hedge fund. So and because it's very odd that the short seller, let's say the guy who published the report, right, put a lot of efforts and try to figure out all these issues and put a lot of money in this price discovery process, information discovery process. If they don't take position, then how can they get any benefits, right? So that's why.
No,
at least yeah.
The reason, I mean, just trying to follow up with that. So it looks like these. If you think the guys who put out the report issue a negative report for some reason, and I'm not clear exactly what the reason is. But if they are holding a short position also and they lose money, then this is like a puzzle, right? So why would you want to put out the report in the first place? Because on average, and you're holding a position, you're getting hammered. Right. So the optimal strategy then maybe to not disclose in some ways.
So that's a great way of thinking about this. But now let me go to the other side, right? So this is actually, so you are basically pointing out to the fundamental reason why there are activists short selling in the first place. The reason is many times the overvaluation can stay there for a long time and it cannot get corrected. So the reason why these short sellers want to disclose the short reports and articulating all these reasons why this firm is overvalued is try to convince other market participants, particularly the long shareholders, and telling them that, you know what, you are holding the wrong assets, sell it, and in this way, the price can get corrected much more quickly than otherwise. So this is a fundamental reason. And if we think about that, right? And later on, I will go to take a look at the distribution of the returns. And on average, these short sellers are successful in the sense that the price on average and a typical case is going down. Okay. And what we are talking about here is basically it's kind of like an anonymous or like unexpected outcome, right? Yeah.
Can I just jump in here?
Yeah. Please.
Just so there is also a reputational thing, right? So which is basically the analyst is putting out information to build his credibility in the marketplace. So even though they may not hold positions, if they say something is wrong with the company, that's a good thing to have, right? So I can't imagine a regulator saying that, you can't tell what information you have. And it seems to me, I have one more point on this whole, when you talked about the price run up, right? So I think there is it's about how much information is out there in the market. So for example, all these listed companies, there's a short interest. Yeah. And there's also a whole lot of information that the funds have to put out, right? Through these, whatever that quarterly report is. In terms of the positional thing. So I'm just wondering whether much of that information, you're going to see this squeeze only in those cases where information about the degree of short selling already in the company is available versus in cases where, the hedge funds are doing it through derivatives or any other off the stock positions, not through the regular equity positions, but derivatives, in which case you can't find this out.
So let me respond in these two parts. The first part is like you talk about the reputation benefits, right? Absolutely, I totally agree with you. And if you go to, let's say, Seeking Alpha or many other online platforms, and there are many researchers or like analysts, like social media analysts, who spend time work on this long and short thesis and without taking any positions. And I think you are totally right. And the one way they can benefit from this is to try to build a reputation and try to get the benefits on that side. Now, the sample we are looking at actually is much bigger, a much bigger fish in this space. So if you go to take a look at these short selling reports, many times it's like very long, and it's the outcome of hundreds of hours work. In that sense, the reputation, the mere benefits of reputation, many times cannot justify the cost of putting out all these.
But they sell these reports, right? I'm assuming that if the reputation is made, then they can charge a huge premium for these reports.
Exactly. So you are totally right. So that is basically the same to what we I mentioned earlier about the balance sheet partners. It's like you don't have a fund, you don't have a big capital there, but you can share your research with another family office, and these guys will pay you later on if the price did go down, right? Yeah, so that's the same thing actually, because from the market, other participants' perspective, no matter whether it's the guy who published the report need to cover or their balance sheet partner need to cover, the outcome is the same. It's like there is someone who need to cover the position if the price goes up and right. So there is no essential difference in that side. Now for the second question, so you are talking about can you remind me again?
No, I was just talking about, let me see, the I've forgotten myself. Maybe you continue. If I remember, I'll call that out again.
It's a very, oh yeah, I remember. Now I remember, sorry. I remember. Now you're talking about
information.
Like, whether this information, yes. So you're talking
Correct.
about whether these funds or these short sellers are taking other strategies that we cannot capture, like they take a, let's say, option, build by put options, or rather than taking short positions. So let me respond this in two ways. The first one is that we later on actually have a test. We find that it's really difficult to predict short squeeze based on the information the short seller can observe before they launch the attack. You mentioned the short interest, let's say the informational environment, ownership structure, all these kind of things does not load in our regression. And our explanation is that, the short sellers are smart guys. They know the short squeeze is a big risk. So if they observe some factors that they perceive that can contribute to the short squeeze in the first place, they will wait, or they will switch the target. They will not do that in the first place. So this is the reason why we kind of like think.
No, I'm sorry. My question was slightly different. I'm just saying, your results saying that the prices actually rise up after a short selling report, right? So if you assume that the short selling report is the first time the market gets to know about the bad information, right? And if you think the prices are running up, that means somebody is squeezing a short seller who has not yet come to the market, right? Because the information itself is new at that point, right? Unless the market is already expecting that short sellers have built positions on this particular stock, then only the squeeze will work, right? Otherwise, the squeeze will not work. In fact, you will double up your short selling bets if prices are running up after the report.
Yeah. So wait, I'm not sure I completely follow your logic. So you're saying,
I'm just saying. See, imagine, right? A company's stock on day one, you announce bad information, right?
Right.
And then immediately, response of the market is the prices are rising instead of falling. Correct?
Yes.
So I'm just saying that means, and your kind of conclusion or inference is that there are people who are squeezing the short sellers by pushing the price up, right?
Yeah.
And my point is that if somebody is doing that, they must be already knowing that there are enough short selling positions in that stock.
Oh yeah. So that's exactly why the short attack is a kind of like a very interesting setting to start a short squeeze, because when this is again related to the fact that the short selling reports are very expensive to write. So these when these guys publish short selling reports, there are high short interest and unhedged short interest. Behind that,
which is what I'm saying. So there's already information in the market that there is a lot of short positions built in the stock.
So you can say this is kind of like already in the market in terms of the short interest, or itself, actually the disclosure of major short selling attack itself is a signal that there are unhedged short positions, concentrated hedge positions, short positions behind that, right? Yeah. Excellent. Okay. So there's other motivations here, like more broadly, we're talking about the bears. The bears we know are in danger, not only polar bears in North Pole, but also the bears in capital markets. This is particularly the case after GameStop. So GameStop actually removed and eliminated many short sellers, including a very famous short selling firm called Statistical Research. And 2 weeks ago, there are more news coming out, like a London-based hedge fund called White Square, which managed multi-billion-dollar assets, also closed because of the loss from GameStop. Now, so given that the short selling is already, later on I will talk a little bit more on this, it's very risky and very costly, and it's already in decline. Should we put more restrictions, more cost, more risk into these market activities to drive them totally extinct? And if we agree that the short selling has a legitimate purpose and have essential roles in the ecosystem, then perhaps that's not a good idea. So this is we hope our paper can contribute to this discussion by providing some discussion on the cost side of short selling, and by focusing on specific risk they are facing, which is the short squeeze.
Hey, just to add to this, just not now, but even in the 90s, there have been several cases where short sellers have been pushed out to become extinct.
Yeah.
I mean, the long-term capital management was pushed out of their short positions, even though the positions did make money eventually. So it is not a new thing. I mean, it keeps coming every decade. So
See, I totally agree, right? So it's so it's kind of like a good reminder to all of us that we should not forget the lessons we learned from history. It's not like after another 10 years or 20 years of bull market and then we forgot everything we have been through, right? So just make sure everyone is on the same page regarding the basic mechanics of short selling. So we can kind of summarize that into 3 stages. And the first stage for the short seller to do is when they open the short position, they need to borrow shares from the broker or lender, and then they sell the shares they borrowed to the open market. So in this stage, first of all, they need to locate these lendable shares. Basically, find a broker or lender who are willing to make their shares available to the short seller. And the selling pressure will push the price lower, right? And then the second stage is to maintain the short position. So they need to monitor the market situation. They need to pay lending fee to the lender. And also, very importantly, they need to have their collateral in their margin account. And so this is important because, you know, it's not like we sell something and then we can use the cash proceeds. No, you cannot do that, basically, because the money you get from selling short a security needs to be put into collateral, and actually you need to pay put a little bit more, usually like 2% more there. And finally, the last stage is to close the short position. The way the short seller does that is to buy shares back from the open market and then return to the broker lender. So the buying pressure will push the price higher, and this is the key in the situation of short squeeze.
One question here, Wuyang, again.
Yes.
So again, I'm not 100% sure about what I'm saying, but I'll just try again. So this buying pressure, and you say when the price goes up in the 5-day window right after the short attack, that there is a short squeeze. So you look at the percentages of price run-ups in that 5-day window, compare it to the price falls, and you say this, you know, qualitatively there are a significant number of price run-ups, and then you provide further evidence. But can some of that be anticipated? The fact that you have a short position, you're going to close the short position at some future date, and therefore there will be buying in the future. Does the market movement reflect that anticipated buying? And so it's not really a short squeeze that's driving it. Is that something you can as an alternative hypothesis? We actively trying to squeeze these guys by buying like insiders, as opposed to just the market is anticipating, there's a short position, because you say these guys have short positions, so one, right? And so
So are you saying that are you saying that so let me just make sure we're on the same page regarding where is the buying pressure from? Are you saying, so I'm thinking about 2 things. First one is the kind of like the short sellers voluntary buying.
Mm-hmm.
Is that what you're saying? It's like
no. I'm just saying in general, people in the price is set based on everything that's going to happen in the future. Right. And so when you observe these short alerts or short whatever
short attack,
so you know that there are these short positions, and you know that they are going to get closed. Yes. And consequently, the buy, there will be the market anticipates those future buys, and therefore it moves. I don't know if this is correct or not, but I'm just trying to make a story which is an alternative to what you call a short squeeze, which is just a normal market, a rational market move.
Yeah. I see. So I guess it would be beneficial to kind of define what do we mean by the short squeeze here, and I think it's Give me one slide because that will help with this. Yeah, that will help this with this. Okay, so the prior literature. What is the prior literature talking about the short selling? And so overall, the short selling is informative, and we have research on that. And this is because the unique payoff structure of short selling, they benefit from the price declines. So they have this incentivize these short sellers to collect negative information, and they trade on that to improve the price efficiency. And also this unique structure make them a very important disciplinary force in the capital markets because they're trying to collect negative information, and that can make sure that the other market participants, particularly managers, to do their job. And the short selling is also very risky and costly. And we already kind of mentioned some part of it. We all know that the short selling has a limited upside because what you can earn, the maximum is 100% when the price goes down to 0. But you have unlimited downside because the price can increase 5 times, 10 times, or 20 times, like in the GameStop situation. And you also mentioned earlier, the short seller need to borrow shares, and these lendable shares are not always easy to locate. And actually, it's becoming less available when you need that most. And also, the lender can recall the shares without notice in advance. And the borrowing fee, which you need to pay to maintain the short position, can be very high and also very volatile. This is documented in Eggenberg et al. 2018 Journal of Finance paper. So, and also there are kind of the prime broker can make margin calls and even force buy-in, basically to liquidate your position and using your collateral, right? And there are also bans on short selling, which is not uncommon, right, in the financial crisis and the COVID crisis currently last year in Europe. And among all these, according to practitioners, the short squeeze is considered the biggest risk. Now, let's talk about the definition of the short squeeze. This is actually
one thing to add there also is the disclosure. So, I mean, during the times of crisis, you may have to disclose faster. So every time you short sell.
Yeah, so that is required in Europe. But currently in the United States, it's not required. So what we are talking about is short selling attacks, where the short seller voluntarily disclose their short thesis is purely voluntary, right? Does it? Right? Yeah. Now, so the definition of short squeeze, actually, we spend a lot of time on this issue. Actually, there is no very, how to say, precise and rigorous definition of short squeeze. So let me just list the definition provided by the SEC. The SEC says that the short squeeze refers to the pressure on short sellers to cover their positions as the results of price increases. So this is the key. The rush by short sellers to produce additional upward pressure on the price of the stock, which then can cause even bigger squeezes. Now, so let me list a few the key elements of short squeeze. So there is a sharp price increase leads to pressure on the short seller to cover their positions. And then covering position itself generates buying pressure. The buying pressure of the covering position itself will push the price even higher. And then this basically form a vicious circle, right? So this is what we usually talk about, the short squeeze. And plus, there are other parts. For example, right? I think this is kind of related to Srini's comment. There might be other market participants. Let's say we call them squeezers. They try to buy to start the price increase in the first place, to start this vicious circle. And also in the process, add fuel to the process, make the vicious circle even more vicious. So this is the definition of short squeeze we mentioned in the paper, and the way we kind of try to focus and try to identify. So the key thing is, I would say this is the core thing. It's the short covering itself will push the price higher, and the higher price will then push more short sellers to cover positions. And why that is the case? Let me talk a little bit more about the mechanics of short squeeze.
Sorry, I would interrupt. One question here.
Yeah.
Seems like there's some kind of a psychological assumption, right? Because if the picture you showed in the beginning is after a few months, the price goes down, right? So it's almost like a knee-jerk reaction. This second thing that you circled is like a knee-jerk reaction to to the price going up, right? So what kind of I mean, do we know something more about different types of short sellers? Some of them may be more long-term oriented. Sorry, long-term is a bad word, but long-oriented as opposed to just reacting to a one day bump up in price. They're going to cover up. Right? It doesn't make sense, right?
Excellent comment and the excellent timing for me to lead to the next slide.
Okay.
What I want trying to say, like long answer short, this is probably not a knee-jerk or like psychological reaction. This is kind of deeply embedded into the institutional details of running short positions. So, okay, let me talk about this, and then Srini, you can tell me whether it's clear or not, right? So, the big thing the big picture image we need to have in our mind is that the short positions actually becomes bigger part of your portfolio if it goes against you. This is very different from long positions. And whenever we buy shares, the price goes down. It's becoming a smaller part in our portfolio. So we care them less. We can even add more weights into that. Short positions is totally the opposite. When the short position price you short goes up, it's becoming bigger in your portfolio, then it will very likely trigger your risk management measures. And let me quote a famous short seller, James Chanos. Even if we love a position, if it's going against us, we trim it back. And he basically has a specific number. He control every short position under 1% of the whole portfolio, right? So even if you're absolutely confident, as many short sellers had in the GameStop situation, right? GameStop, how can you justify a $400, $300, $200 price for such a company, right? There's no way, but the price can go into the roof. Now, and there is another thing, right? Like when the fund is trying to raise capital, they usually need to show the process and kind of like a rigorous process to tell the potential investors that, hey, this is the way we will manage your money, and this is the way we'll make money. So this is called a investment management agreement, and many times they have a specific the maximum size of the short positions. So when the price go against you, and then as a result your short position exceeds such risk management thresholds, then no question will ask, just close the position, just close it. And this is not related to whether you can handle it psychologically or whether you have faith in the long-term value. It's all irrelevant. It's just for risk management, right?
Okay.
Yeah.
So Wuyang,
yeah.
I'm sorry. So I used to be part of GSAM's hedge fund in New York.
Oh, excellent.
So as a quant fund, so I think what you're saying makes sense if you're talking about people who are looking at fundamental investors. So if you're looking at quant, for example, right, half the portfolio is short positions. Yeah. And there the individual positions does not matter. What matters is the portfolio shorting. Yeah. And I think in that respect, some of the quant funds have a larger appetite to continue the short, even beyond. In fact, for example, in GSAM, we used to take month-long shorts, despite the market going against us. So I think it depends on the strategy of the investor.
Excellent. Now, so the point I want to make is, as you said, right, the quant funds, they take a portfolio, right? They don't do research specifically on each firm, right? Generally speaking. Now, that is not that type of short seller in the context of a short attack. When you short attack firms, in all of my cases right here, it's just the one firm. You publish detailed research about one firm. So by definition, your short position on this type of firms is not diversified, right? So that's the reason why you care a lot. And to your point, like the quant funds usually are not the balance sheet partners of these guys who publish short selling report, because this is not their business model, right? Yeah. So And in the process, right? As I mentioned earlier, the short seller need to put collateral there, and it reaches like usually 102, 105% of the market value of the short position. So when the price goes up, the collateral also need to go up. So you need to put more capital there, and also at the same time, your prime broker might feel nervous, and they will cut the leverage they will provide to you. So in other words, it's like, when you need money the most, actually there are also more demand for you to put more capital there. So all these things will put together. When the price goes against you on your short positions, you have a very big urgency to cut the position and reduce the size of your short positions. And this is kind of related to Peterson mentioned in this famous liquidity spiral. Right. So basically, you need to reduce your position, and then the price will move down, and then you have higher margins, and you have losses, and then you have tighter risk management. You have funding problems, which make you to sell more positions, and that will push the price even lower. This is for the long side, and for the short side, it's the opposite. For the short side, it's opposite. Okay.
So beyond one clarification comment here. Yeah. So a lot of, when you said, let's say I'm giving out a report within my own research saying this company is going to do badly, and then suddenly the market is going up, right? Yeah. So one very naive explanation could be that my research was bad, right? So is it possible that the validation with the public information, let's say the company comes out with its financial results or something which validates my position, that will determine whether I double up my bets or sort of decide that maybe my research is bad and I need to fold up?
Yeah, so that is one alternative explanation we will address, and to the extent that is, so in that case, right, it will not be able to explain why there is like much more reversal happens after the initial price increase. So if you can give me like a few minutes, we'll have a specific discussion on all these alternative.
No, in fact, in fact, that might, in fact, I would say that that's exactly the reason why the reversal happens, because public more information comes out about the bad news. So which means the market cannot justify the price rise in the first place.
Yeah, so you're saying you publish a short report, and then the firm discredit, like provide some disclosure, kind of discredit
more information, right? I'm saying some
the
other people do it, or maybe the firm provides public information. Yeah, like the financials are looking bad.
Yeah, sorry. So so we have a specific test about a specific type of additional information, which is the firm's disclosure. We show that actually there is no more disclosure from the firm side. And yeah, give me a few minutes, and we'll talk about that specifically. And then okay, so there's some research about the short squeeze. Let me be a little bit quick on this. So actually, so the prior literature on short squeeze is mostly, at this point, it's mostly about these case studies. Most importantly, it's about the Volkswagen short squeeze in 2008, which is a very famous one. And I'm expecting more short squeeze research on GameStop is on the way. And the prior literature on the short squeeze talked about the demand side and the supply side when the short seller tried to cover. So from the demand side perspective, right? There are two papers, Harris Hong et al., JFE, and the last are car paper, was talking about the short sellers have bigger urgency to cover position when they face with unexpected positive news. And they talk about this in the context of the positive earnings announcement. And I'm having a paper with Sanjeev Bharadwaj in Cornell University on the supply side of the short covering, which means that when the short seller try to cover the position, if they cannot find enough shares from the owners from the owners, for example, these passive owners, insiders, long-term owners, they will not sell shares to the short sellers. So if for firms, for short sellers in these firms, these type of firms, they have a bigger issue because they have a supply issues of shares when they try to cover the positions. Now, for all these papers, the short squeezes are triggered by the price increase, usually caused by the positive earnings. And for these papers I summarized here, they are all using the positive earnings surprise and as a setting to generate this positive news. And in our context, we focus on the short selling attacks, which is basically intended to decrease the price, and which is containing negative research, negative news. Now, so
there's a lot of research on the bond markets. I don't know whether you refer to them in your paper, but there is a short squeeze of the treasury bond markets, like basically the futures.
Oh,
for the famous short squeeze is on Japanese government bonds.
Yeah, we need to
hedge fund.
We need to take it. We need to take a look at that. We have not. Thank you. So there are short selling attacks. So their prior literature shows that they can accelerate the price discovery, and usually, generally speaking, they did a good job identifying these overvalued stocks. But again, as I mentioned earlier, the research is very expensive. So they usually take material short positions that are usually underhedged. So when the short sellers disclose a short attack, and then it immediately alerts the whole market that, you know what, there are some parties in the marketplace who are taking concentrated material unhedged short position. So this is an invitation or reminder for other people that, you know what, if we want to short squeeze, here's the chance, here's the opportunity. Now, so in case I don't have enough time to go through every tables, and let me summarize our main findings. So overall, we find that over 30% of these short attacks had immediate positive returns, and half of them fully reversed in the first 3 months. And this is a lot more frequent. This half of the reversion is a lot more frequent than these short attacks with negative initial returns. And we rule out alternative explanations, including the information-based one. And we provide evidence of very high short covering. Now, we find it very difficult to predict short squeeze in the first place based on the information the short seller can observe before the attack. But we identify a few things that on the day after the short sellers launch their attacks, there are a few things that beyond the short seller control can actually contribute to the short squeeze, including online settlements, the market-wide return, and also most important is the insider purchase. And finally, we kind of provide a quantitative analysis on what is the cost of these type of short squeeze cases on the short sellers. And we find that it's a lot more, it costs them a lot more than a similarly calculated profits they can get from a successful campaigns. Now, so let me skip the contribution. So we get a sample of 1,400 short selling attacks in the past 15 years. Now, so if we take a look at the returns, we can find that on average, on the day of the attack, we find that the price dropped a lot, and there is drift. If we look at later periods, there is still drift. So in other words, a typical short selling attack actually is successful and is driving the price down and is generating profit for the short seller. But if we look at the Q3, right, we can find a variation there, and actually the price is not moving down in the first few days in that distribution. Now, so how prevalent are the positive returns after attack? So we tabulate the frequencies of positive returns in a few windows after the short selling attack. So let me pick one, how to read this. So let's say for this number, which means that in the first 5-6 days after short selling attack, 226 campaigns out of this 1,400 are having returns higher than 5%, meaning the price increased more than 5% in the first 5-6 days. And in retrospect, like as a comparison, right? So there are 700 short selling attacks having returns, have price drop more than 5%. So again, this comparison also indicates that the short selling attacks are overall driving the price down more frequently than driving the price up. Now, and so this is based on the closing price, and the panel B is based on the maximum and the minimum price, which gives the similar the same inference. So let me skip that. Now there are a few explanations, right? Like the market was expecting much worse, and the market is interpreting the price positively, and the managers successfully discredit the reports, and there's just a pure coincidence. And if all these explanations basically point out that, you know what, the short sellers report actually does not contain information regarding future cash flow that justify the price should be going down. But if that is the case, then we don't expect more frequent reversals. But our explanation is that, you know, this is short squeeze going on, and the short squeeze by definition implies that there is a reversal later on, because the short squeeze means that the price was pushed up by the short sellers' urgency to buy, to cover the positions. And later on, when this buying pressure fades out away, and then the price will reverse back to the fundamental level. So in this way, we basically compare the frequency of reversal for these campaigns, short selling attacks with positive returns versus these campaigns with negative initial returns, right? So how to read this table? So it's structured. Yes.
So Wuyang, just a question. If you go back to the next slide, where you were talking about the market expecting a worse outcome, and basically, you know, therefore they are reacting positively.
Yeah.
But then you need to then look at -5, or I mean, there must be a price run down prior to the thing, right? So when you do your cars, don't you have to look prior as well?
Yeah. That's an excellent point. Yeah. So we have not tabulated in the paper, but overall, we should have. Yeah, I think you're right. We should have, let's say, show the return in the previous several days, right? The price run up, and the basic statistic is that actually the price is on average is rising up before the short attack. Actually, this is another reason why the short seller pick up a certain date, and many times it's because they find that they have all this research ready, and they find that if the price is rising up, and they try to build their short positions, and then they release the short selling report. So you're absolutely right, and I think that is a good way to provide further evidence that this explanation, the market was anticipating much worse, does not hold. You're absolutely right. That's a great suggestion. We'll do that. Yeah. We took a look, but we didn't incorporate that into the paper. Yeah. So let me pick one number. So this number means that for these short selling attacks with initial positive returns in the first 5-6 days, almost 50% of them reverse, right? If the initial return is higher than 5%. Now, by comparison, if we look at this initial return lower than 5%, negative 5%, drop more than 5%, I mean, drop them more than 5% in the first 5 days, then only 23% will reverse back, fully reverse back. So this asymmetry give us evidence that, you know, probably this is short squeeze going on, because if we think about the reversals, we have more reasons to believe the negative initial return are more likely to reverse, because, you know, to the extent that their short sellers are manipulative, they short the company and basically distort the price, and then they're more likely to reverse back. And also, if we have the belief that the price is generally moving up, then we also expect that these initial drop are more likely to reverse back than these initial positive return campaigns.
Wuyang, a question, maybe a statistical question.
Yes.
So you have these two side panels on side by side. Don't you want to have some kind of a benchmark? for people who don't carry like a control sample to see what the price, some kind of a null, what would be the distribution?
Yeah.
Because even when I read you basically conclude like 30% reverse, but that's like a qualitative conclusion, and and that's maybe economically important, but I really don't know as a reader what to conclude wrong, or unless you have some kind of a statistical test. This is the benchmark. What is the normal distribution?
That's an excellent suggestion. So currently, what we do is basically to test these two numbers. It's basically to use the negative initial return campaign as a benchmark. Right. And so this is kind of not a typical benchmark. I think the way we talked about that we can do is to kind of like do a bootstrapping, like to generate like for a typical non-news scenario, and then repeat that for 1,000 times, and kind of generate a distribution for that type of scenario, and then compare. But that excellent suggestion. Yeah.
Just another alternative. Sorry.
Yeah, go ahead. Becky, go ahead.
Another alternative here, right? If you look at the right side, which is 0.23, so that's basically market overreacting, right? So there is a bad news, market pushed it too bad, and then the prices revert. So that's a standard overreaction story. On the left side, you're talking about a market going up after a short report. Maybe there is more short sellers needed to come in, and therefore there's a lot more bad information that got unearthed subsequently and pushed the price down even more. So I'm just saying that asymmetry is because of two different economic things going on, and one of them could be the short squeeze, the other could be that additional so usually bad news comes together as a cluster, right? So like one bad news comes, another bad news comes subsequently, and so on.
Just make sure. So for this one, I think there is an element of overreaction, but this one, when we define reversal, we define it as full reversal. It's not reverse a little bit. It's full reversal, meaning that the price level is even higher than the level before the short attack, right? For this negative initial return cases. So again, as I said, like it's probably there's an element of overreaction, but the overreaction is not the full story, right? So this is the first part. The second part is for this positive return, initial return, and then reverse back. The reason why they're reversing back, there might be more negative news coming out, and from more short sellers, right, who collect more new information. But what is that? What is the reason why the price rise up in the first place, based on your explanation, which like other than the short squeeze? I just want to try to.
No, but I agree with you. See, I think the price run up, as I said, right, has to do with what happened before the time zero.
Yeah.
So suppose if the bad news was not as bad as you said, right, in the previous slide, then you might expect a price rise on day zero after the report. But then that report gets supplemented by additional bad news, and then now market feels like, okay, it's really bad news, so let's kill the stock.
Okay, so you're saying okay, so let me make sure I understand that. So you're saying the market was expecting much worse, so when the short selling report coming out, it's not as bad, and then the price rise up. So this explains why there is a price rise up in the first few days, right? And then later on, more negative news coming out, and then the price comes back.
See, I think it might make a lot of sense if you benchmark your returns rather than looking at it just around the event. Suppose you look at it 10 days before.
I see.
Right.
I see.
So then all of these things can be sorted out, right? Because then you're talking about really price moves before even the report. So whether there is any,
Excellent. Great. Yeah. So your point that looking at returns prior to the attack, it's a great point. Yeah, we will do that. Yeah.
So
Okay, so
Wuyang, just to sorry to bring time up, but we have about 10 minutes left.
oh, excellent. Yeah, so that's perfect. That's perfect. So we also did a regression. So basically, it's just a regression version of the test between the positive initial return and the negative initial return, and check whether there's asymmetric reversals. And the way we do that is to create a dummy variable of positive initial return dummy, and they interact with the return in the immediate periods after short-term attack, and they use the subsequent return as a dependent variable. So we find that the negative association between the immediate return and the subsequent return is becoming much more significantly negative for these campaigns with positive initial returns. Again, this suggests, again, confirms that there is asymmetric reversals conditional on whether there's positive and the negative initial returns. And we also see that, we can also see that from a graph. So for example, for these positive initial return campaigns, it's almost all coming back like to a greater degree. And for these negative initial returns, and they're still kind of like quite low in the graph. Okay, so there are other alternative explanations that can even provide some possibilities for the reversal. So the first one is that, you know what, there might be just this, it's not short squeeze, it's just these short sellers already got enough profit, so they cover the position and they're covering, push the price higher. So this is unlikely because, you know, if you are profitably covering your position, you might push the return from -5% to -4%, but you cannot push the price from in the positive territory, right? From the 4% to 5%, because this, by definition, you're already losing money, right? You're already losing money. So this is unlikely. And the second alternative explanation is that the managers might issue misleading disclosures in the following sense. They issue a disclosure that is untrue, but for some reason they convinced the investors. And then when later on the investors figure out, then the price comes back. So this can also explain the reversal. But then we did one test, right? Like we try to check whether this indicator of positive reversal, which is kind of like our indicator of suspicious short squeeze cases, actually it does not associate with the firm's disclosure. And to some degrees, actually it's related to less management disclosure in the time periods in these windows. Why? Actually, there is an easy explanation. When the price is moving up after short-term attack, the managers have no incentive to disclose anything because the ball is not in their side. They can just observe, see how the short seller respond to this. So this seems like unlikely explained by the manager's misleading disclosure. Now, is that because the investors just paying more attention? Like, let's say these retail investors who is unsophisticated, they just pay attention to the short attack, and then they buy. They did not digest the short selling reports. They just go to buy the shares. And it's very difficult to test this very directly. But the way we check this is, okay, if that's the case, then probably we will see more online discussion, right? Because online discussion can be a proxy for how active the retail investors or these unsophisticated investors are paying attention to the short attacked firm. And we check that. We use a Ravenpack, the number of articles from Ravenpack web edition, which cover all these online discussions, and another variable which cover everything, including Wall Street Journal, you know, these major outlets. And we didn't find any statistically significant results. In other words, these suspected short squeeze cases are not associated with more online discussions. So this also is inconsistent with the alternative that the investors are paying more attention. The final thing is perhaps there is just a mechanical that if the positive initial return have a smaller magnitude, then they're just easier to reverse for some random reasons. And then we compare these positive returns with reversal versus these positive returns without reversal. And the return magnitude actually are very similar. So that is also not the explanation. And
so
then
one control variable I was thinking, the small denominator problem, right?
Yeah.
So the price levels are different across the two groups. That might be
right.
So the level of the prices determines the path just
Good point.
mechanically, arithmetically, and that you might want to control for that and see if average prices are different.
Yeah. That's excellent. Yeah, great. Thank you. So we also check the short covering because as I mentioned earlier, the one key element of the short squeeze is short covering. So we check the raw short covering level of these of these campaigns with positive initial returns and the reversal later on, and we find that it's very significant in a very long period of time, and also it is at high level. The short covering is at high level than other cases. In particular, let me highlight this one, which is the short covering after positive earnings surprise, right? And for that group, actually, their prior papers show that there are short squeeze going on. So we show that if we use this group, the short covering level for the positive reversal case minus the positive earnings surprise case, we find that the positive reversal case had a lot more, significantly more short covering every day after the short selling attack in the next almost 20 days. Okay, and so in the next several minutes, I'll just quickly cover three tables. The first one is it's very difficult to predict short selling, short squeeze. And based on the existing short interest, ownership structure, information environment, it's very difficult to predict. However, the incidence of short squeeze are associated with a few things that happened on the day of the next several days after the short selling attack, which is already beyond the short seller's control. This include the online settlement, include the insider purchase, or buy and sell imbalance, and also related to the market return. So again, these things are beyond the short seller's control. Now, the final table I want to show you is to estimate like how costly this short squeeze to the short sellers. So let me use the case in the very beginning to show how I calculate this. So the way we calculate that is, suppose the short seller need to cover the position at the highest level of the price, and then compare that with a proxy of fundamental value, which we use the closing price at 1 quarter later, right? We assume that the price will reverse to the fundamental level 1 quarter later, and then use the price difference multiplied by the short interest prior to the short attack. So this is kind of the cost to the short seller had the short seller forced to cover the position at the highest level in the first few days. And for the Hindenburg research on Voigt case, we estimate that there's like almost $30 million, which sounds a lot, but actually, if we look at the whole distribution, this is like, it's only a median, it's a median size. On average, they're like $70, $80 million loss. And if we estimate estimate the benefits or the gains the short seller can get had they covered the position at the lowest level for these successful campaigns, actually the money they can earn is much smaller. In other words, this basically provided another evidence that the short squeeze is really, really costly to the short sellers. You need to have 2 successful campaigns to cover the cost you had for squeeze campaigns. So let me stop here. So the conclusion I want to draw is, there are short squeezes going on when we see these initial positive returns after short selling attack. And the short squeezes are very difficult to predict, and they are related to issues that are beyond the short seller control. And the short squeezes are very, very costly to the short sellers. So the overall takeaway in the future, if you see a graph like this, so I hope we all agree that there are some short squeeze going on. Thank you so much. Thank you. And all these comments are very, very helpful. So I will share the recorded video with my co-authors, and we will make a revision.
Thank you.
Thank you. Yeah.
Thanks a lot, Wuyang, and thanks to all the participants. Yes. Oh, that was okay. Thanks, Wuyang, again for coming over and presenting your work. It was very interesting. Enjoyed your talk, and thanks to all the participants for coming. And wish you all the best for the paper. And
thank you.
successful.
Look forward to meeting in person. Yeah.